So, a lot of people, when they think about what the goal of retirement is, they think the coolest thing would be just to hang out here at the beach. So, how would you be able to do this? A lot of people are trying to retire in their 20s and 30s now. You know that there's actually this whole big movement of people just saying, "Hey, I can retire in my 20s and 30s." But a lot of them are trying to do it with dividend-paying stocks. Now, the average income in the United States, I think it's about $63,000 per year. So there's some dividend ETFs that exist out there that they pay around like 3.4%. And so in order to make that kind of money, like $63,000 a year, you know how much you have to save in order to make that? You actually would have to have about like $1.9 million in order just to have like a middle class income. Now, that wouldn't really allow you to live in a place like this because California is a very, very expensive state in general, and Hermosa Beach is even more expensive. Nevertheless, I do believe that a lot of people can become financially wealthy enough that they could probably live on this income, but they would have to live like in Airbnbs around the world. Now, that's not such a bad thing. I think that the Airbnbs are an affordable way to just to travel around and stay in affordable locations. What do you think about that, Danny?
What? I wasn't paying attention.
Do you think basically, if someone had like 1.9 million and they had it in dividend stocks, that would be enough to basically have like the middle class income in the U.S., right?
Somewhat. Depends on what middle class part of the country you're in. New York is a very different middle class.
Oh yeah, that's different middle class. But in general, what people can do with these dividends is that we should actually get into what are dividends, because everybody's talking about it, but nobody's really defined it. Dividends are basically companies that are mature and don't really need to use all of the money for new research and development and stuff like that. Like, let's say Coca-Cola or tobacco companies or apartment complexes. They don't really need to use the money for research and development, so they're able to pay their shareholders the profits. And now, these kind of companies don't probably grow as much as other companies because they're using all of the money just to hand it back to the shareholders. So if you own like Coca-Cola, you own tobacco companies, Altria, or you own some commercial real estate, they're going to just pay the dividends. And so the dividends are pretty reliable. And dividends are actually not a guaranteed thing with a lot of stocks. Some stocks, especially this year, a lot of them actually cut the dividend quite a bit. Actually, a lot of them cut back substantially because the money just wasn't there. A lot of people stopped going to this, buying the products or services, or if it's a hotel, people are just not staying there. Then they're going to be cutting back on the dividends, and that's a problem if you're relying on the dividends. So I think it's really, really important to, if you are a dividend investor or using it to retire, you have to consider how safe the dividend is. Some companies are not a lot more resilient than others. As an example, like I've talked about realty income before, but that actually is a pretty reliable dividend. They have never cut their dividend. They've always grown their dividend. And even this year, when a lot of crazy stuff was happening, they did not cut their dividend at all, and every dividend was paid. So that's a pretty impressive stress test that it happened that way. So you might ask, why care about dividends to begin with? So many people, they actually want to retire very early. I think that actually what brings so many people to these financial channels. They hate their job, and they're like, I just want to retire as soon as possible. That probably is the wrong approach when it comes down to dividends, because if you're just living paycheck to paycheck, putting all your money again 3 or 4% is probably not going to change things too much. So I think some of it has to do with the wrong philosophy, that they think, oh, this is a magic bullet and I can automatically just make enough to retire off of it. I think you first have to actually focus on making a ton more money with your present job. You're going to have to try to make the highest possible salary you possibly can and save a ton of money in order to actually have enough that the dividends do matter. Because if you're just putting a few thousand here and there and you're getting a little bit more than you are in the bank account, it's just not going to really move the needle all that much. And I think that's one of the flaws that people have when they're looking at dividend stocks, is that what is your mindset? Is it just retire and hang on to the beach? And that's fine. I'm at the beach right now, but the most important thing is you have to think about your mindset.
Away from the beach.
I'm walking away from the beach because I can't afford it, so I'm trying to save money by not going to the beach, and that's the strategy. So what are some advantages of actually dividend investing? For one thing, it can actually be sort of like an income. It could actually replace an income if you have enough assets, and the money comes automatically. You don't actually have to trade in order to get the dividend. You don't have to think much about it. It just comes automatically when the company pays a dividend. But there are negatives about this too, because I think a lot of dividend investors become rather lazy. They don't really focus a lot on the company's performance, where the stock looks like it's sustainable. As an example, I believe GE was at one time a fairly good dividend paying stock at one point in time. But guess what? It's just a complete failure of a stock, and I don't think it pays much of a dividend at all. A lot of companies, they once paid great dividends and they're not paying any dividends. So I think it sometimes creates complacency. People start to get lazy. They're like, oh, look at this great dividend. I don't have to think about the company's performance. And I think that's almost, I think that's one of the biggest dangers of dividend investing. The other problem with it is I think that it's sometimes the focus is on just receiving this dividend, not really thinking about the stock long term, whether this is a stock that's really going to make huge moves. Like for some of my best stocks that I know have made incredible moves, they don't pay hardly any dividend. Like think of MasterCard, Visa. They don't pay hardly any dividend whatsoever, and there's a good reason why, because they use the profits to research and development, and it allows them to have a huge cash cushion in order to grow the business dramatically. So oftentimes people are just focused on the wrong thing. Warren Buffett did not get rich off dividends, as an example, and he doesn't pay dividends either if you own the stock. Most people did not get rich by getting the dividend. Dividends are for one purpose, is to preserve your style of living, or like just to have a fixed, kind of almost a stable source of income, but it's not for the purpose of getting rich or anything like that. So that's the one thing to keep in mind. Now, another thing about dividends that I think is a cool factor with regard to these dividends is that you literally cannot fake dividends. Like when they pay out the dividends, it's not as though they could just pretend that the money is there and hand it to you. Now, you know, sometimes companies, they do funny business and maybe they're not reliable. Well, that if you have questions about their financial performance, one thing about dividends is that they actually have to have the money in order to pay you. So that's one thing about it, is that it's actually a real thing. It's also important to keep in mind that the tax rates on dividends has changed over time, so that may be a factor for you. Some people think that the rates are low at the moment in terms of the tax rates, and it may go up or it may go down in the future, so that's also an important consideration. The other thing to keep in mind is if a company is able to continue to raise their dividends, it might be a good example of how their financial performance is actually doing rather well. So that's also something to keep in mind, because if they're able to continue to raise the amount of money that they're paying you, it might be an example of how they actually are doing relatively well, enough to actually pay you more and more as time goes on. Like for instance, the reason why they're always able to pay more and more stock dividends is because they have their tenants are long-term. Their tenants have long-term contracts, and the actual rent increases are built into it. So that's one reason why they're able to raise the rates over time. Another thing is, you don't want to be in a position where you are trading a very high dividend rate for very poor financial performance. As an example, AT&T stock pays about 8%, but their performance as a stock has been absolutely terrible. So I don't recommend buying AT&T. There's no reason to buy it to get an 8% dividend if the stock is not going anywhere. That would be a complete waste of your time. So please don't buy AT&T stock. Even if you need 8% to pay expenses and things like that, as you need a reliable income, there's no guarantee that considering the stock is not going up, I think it's a sign that far too much of the money possibly is going to the dividend, or it's just not a great company overall to invest in. So definitely don't chase the dividend yield. So another strategy that I highly recommend is, if you are going to be a dividend investor, what you should do is do not reinvest the dividends in the same thing where the dividends came from. Make sure the dividends get sent to your account in cash and then reinvest in something that is going to appreciate a lot more. Like what I do with my dividends, I get it in cash and then I use it to buy Bitcoin instead. I know some of you are going to say, what the heck? That's the most insane strategy. Well, what's going to go up, more likely to go up 100 times? Bitcoin or just some passive, boring REIT? I think Bitcoin is far more likely to do so. So one thing to keep in mind with dividends is that it's not really a way to actually get rich off the dividends. What's important about it, it's a way to maintain your status of living and to basically live off the dividends. But a dividend itself will not make you rich. And I think that's something that's important to keep in mind. You see it in all the channels. That's not how anyone got rich. None of them got rich on the dividends. Basically, they use the dividends either to reinvest, and if you're younger, it probably is a good idea to reinvest the dividends instead of just living off them, because it probably hasn't grown to a point where you can live off of it. But if you reinvest it, it can actually accumulate over time if you're buying more shares with it. So I think that's the best strategy. So there are a few negative things about dividend investing that people don't oftentimes talk to you about. One of the negative things about dividend investing is that it actually is very tax inefficient. Now, by inefficient means you get taxed. Now, this is not true if you have it in a Roth IRA or a regular IRA. You do not get taxed on a yearly basis. In a Roth IRA, you never get taxed on it, on your after-tax earnings, and on a regular IRA, you get the taxes deferred. Okay, so let's get to a regular taxable account. There are two different kinds of dividends. There's a qualified and an ordinary dividend rate. The ordinary income dividend rate is basically your your highest income tax rate. So that might not be a great thing for a lot of people. And then the qualified one is a lower preferred dividend rate, and it's basically the same rate as your capital gains, long-term capital gains rate. So in other words, basically the best way of explaining it is that yes, you're going to be taxed on it every single year. Whereas think about like a stock that you hold for decades and you never sell it, well, you don't get taxed on it until you sell it. Whereas if you own a stock that's paying a dividend on a monthly or a quarterly basis, you're getting taxed every time the dividend is paid. So it really just depends on if you like how tax inefficient that is. Another issue to keep in mind is that by handing you a dividend, the company is not using the dividend to grow their business, like research and development, things like that. And so in general, this is money. These kind of companies don't usually grow as much. Like think of a tobacco company. The reason why they're paying you all the money is because they're not using the money for research and development. There's not a whole lot of research and development for tobacco companies because the technology is kind of old. They don't really need to use the money for that kind of purpose. Or think of like a commercial property. Because they're paying you the dividend every month, they oftentimes have to have a lot more debt instead of just using the money to buy more properties. So I think of that as kind of a negative that exists with these kinds of investments. So what do you think, Danny? I know you don't. Here's an example. This guy, he doesn't like dividend paying stocks at all. He thinks they're just crap. What do you think?
I like to chase what's going up.
So he doesn't care about the dividend. This is not relevant at all. It doesn't care about that. Thinks it's the wrong thing to focus on.
Hey, watch where you're going.
I know. This can actually block the view because it's so bright. Anyway, it's the best to actually focus on what is actually going to bring you the most amount of money, not necessarily what's paying you a dividend. I think far too many people are focusing on the dividend instead of thinking about, hey, don't I want a company that's actually making a ton of money and as a result makes me a ton of money, instead of saying, oh, I want my guaranteed 3 or 4%, which is not guaranteed. Like think of Disney, they cut their dividend a lot, or Win, their dividend was cut to nearly nothing. So you don't want to focus only on the dividends because really that's not relevant in the long run if they're going to cut the dividend. So the one last comment I have to make is the most important thing in terms of retirement, if you want to retire early and young, has to come from within. You have to be really cheap and save your money, because the truth is dividends are not likely to replace a middle class income very easily. I mean, like I brought up earlier, you would need about like $1.9 million invested in like a Vanguard high dividend stock ETF in order to make like $63,000. So it comes from within. If you are really very crafty, you know how to save a lot of money, or you can actually cut down your expenses quite a lot, and that would really put you in a position where you would be able to retire early. So that's it for today. Be sure to subscribe, hit that notification bell, and definitely smash the like button. And see you in the next video. What do you think of this light, by the way?